Stocks had risen from March 2009 until January 2018 relatively unfazed. There were few setbacks along the way. Central bank intervention was successful at devaluing the dollars effectively to make the nominal value of the stock market rise. There was also one other factor that has been forgotten in the mainstream, but not here. And that's why you came here for the truth. So let me unveil that for you. Today, we are going to look at the global economic collapse, various indicators to show you, and one, most importantly, beginning with this, cumulative flows by client type, January 2008 to present. You could see the hedge funds, institutional, and private client, all net sellers. What does that tell us? If they're all in net sales, who's buying? Well, we'll take a look at that right now. Since the tax bill, companies have been doing a lot of buybacks. Share buybacks in 2018 have averaged $4.8 billion per day. That's double the pace from the same period last year. Essentially, what's happening is that we can see the stock buybacks have contributed to a great degree to what we can see in the stock market today. The central banks are leading the charge. They've been printing up money. We're looking at hundreds of billions of dollars every month going into this system. And then on top of that, you have stock buybacks. And then you have all the little minnows, all the retail investors chasing the big fish. Goldman Sachs in February estimated the S&P 500 firms will return $1.2 trillion to shareholders via buybacks and dividends in 2018, increasing share buybacks by 23% to $650 billion this year. That number could very well increase, as it does oftentimes. It goes on here to give you some, examples. Pepsi, $15 billion buyback. Google's parent company Alphabet, $8.6 billion, and so on. These are massive by any stretch of the imagination. We are not talking about, some buybacks here and there that are going on. It's been going on for years and years. But ultimately, we could see today at a higher level than we are used to, and that's basically a sign of weakness. There is so much weakness today, and unfortunately, the mainstream will never acknowledge it, even when it's too late. Even if you look at the information that was coming out in 2008 and early 2009 in the mainstream media, they were constantly suggesting these are the stocks to own, these are the safe stocks, these are the ones you have to get into, these are the ones that haven't been hit the hardest, so you should put your money in there. Not thinking of diversity, not thinking of money management. No. Where do you put your money today? Is it this stock or is it that stock? Or is it this bond or is it that bond? Which fund should I invest in? No. We need to know how to deal with our finances and not just choose one or the other and they give us that choice. It's no different than the left-right paradigm. The rise of buybacks, net share repurchases, non-financial corporate sector as a percentage of GDP. And if I put my mouse over this, you will be able to see somewhat here as a percentage where this has come from, where it's going to go. Stock buybacks are at an incredibly high level, and that personally shows nothing but weakness. Now, there is a site that you can check out if you're interested in looking at the stock buybacks. marketbeat.com/stock-buybacks. All right. And here you can scroll through the list if you're interested, showing you all these different buybacks I happen to find here. I'm sure there are many resources. This is just one that I've seen. And you can go through the list. You can organize it by percentage of shares or buyback amount. It's not really organized that well, but you can do a company search on here and just do a find on the page to look at the one you're interested in. Then you can see how much they are going to do and their announcement. So they can increase, it can decrease, but this is what they've told everybody that they would do. So if you want to know what's happening with stock buybacks, and I believe that you should, then you want to be able to look at this site and look at various others. I will obviously be covering it on the channel regularly, so you can get that information here, but always just go to a search engine and type in stock buybacks 2018, or if it's 2019 and so on, you could search for that and see where they have come, how much they have been buying back. It's important. Number one, we have the central banks. Number two, we have stock buybacks. And then, of course, beyond that, the institutional investors, and then everybody else, the minnows, chasing the big fish. All right? Now, switching gears here, we're looking at the IMF constantly warning about the tides turning. You can actually see, we can see darker clouds looming because of what's happening, because of all the tensions that are occurring here, because of what's happening between, going back and forth with China, the US. I get that. And here you can see what the IMF has been warning about. Now, the IMF, clearly, the technocratic elite, they are not a good institution, but I definitely like their reports. I definitely like the messages that they put out there. Their solutions, not very good at all, that's for sure. Take a look at this. Now, you saw the whole shorting of the VIX, betting it was going to continue to stay low. That went absolutely insane. And ultimately, what we saw was people trying to cover up. And as a result, they have been holding on to these positions long, and this is, basically at a record we've seen, at least in the last little while. That bet to short the VIX isn't really working anymore. We've seen it come off the highs, of course, when you look at the VIX, but ultimately it's still very volatile, and I believe that traders are now starting to suggest maybe we'll see some continued volatility for the time being, and I would have to agree with that. Our equity risk indicator hit multi-year peaks in January. This is Morgan Stanley. And you'll see here that, remember, it's not just the nominal value of anything when you're looking at particular stocks or anything, any indicator. It's the difference in between 1 month to another, or how high it was and how low it became. And you can see this here, where it was previously and where it is now. The equity risk indicator severely dropped. And that's not necessarily a big drop in the S&P 500. As you can see here, it's a little blurry, but essentially what we can tell is that things change very, very rapidly. If there's any truth to, what we can see with the markets, it's that the sentiment changes overnight. So we have to be prepared, and most people are not. They're saying, look, if things get bad, I'll just go to money market. I'm fine. No problem. Okay then, good luck. American Association of Individuals Investors Percentage Bull reached a very high level in January. So there's the euphoria that we see right at the tip here, and look at where it has gone. Short period of time, big drop, that's all. The percentage of bulls seems to be decreasing in a very, very short period of time. It's a very volatile indicator, as you can tell. I wouldn't put too much weight on this at all, but just figured I should mention it. Now, there has been talk about China and Russia being currency manipulators, and to suggest that is to say that the sky is blue. We are looking, actually, if I look outside, it's gray. But anyway, looking at these two countries in a vacuum is not fair, because all countries manipulate their currency. Every single one. 100% of them. The US does it. Japan does it. Every country in Europe does it. All of Asia does it. South America, Africa, they all do it. Every single one. Some of them do it a lot. Some of them do it a little bit, but they all do it. So to say that one individual country is a currency manipulator is to manipulate the public because they don't know it. They don't know how this works. You and I know it because we follow this information, but they don't. So you can see that actually in the short term here, the ruble and the Chinese currency, the yuan, renminbi, have actually appreciated recently versus the US dollar. So who is the depreciating currency? Here's the dollar index dropping significantly recently, and we have seen where it has come from over these past few weeks, going back into levels that were not seen for a month now, essentially, almost. And last but not least, just wanted to touch on this point very quickly, the soft survey data, hard real data. Ultimately, they've both been declining over the past couple months here as the stock market has declined. I don't know what kind of hard data they're talking about here. I'm assuming, just going with the assumption that the fake jobs numbers are pushing this up. But either way, when you look at all of the data all together and you're actually taking it head on for how it is, doesn't look pretty. Well, that's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, it helps to support this channel. So I do appreciate that very much. And last but not least, if you found this video informative, I know that you will find my books, The Money GPS and my newly released Global Economic Collapse, even more informative. Take a look at the link in the description. That's going to bring you over to Amazon. You can actually flip through the pages of these books to see if you like them. Take care.